Hey guys, this is Kronos bringing you an intro to Peercoin. If you're interested in Peercoin and want to know more about it, or if you own Peercoin and you ought to know more about it, you've come to the right place. I really think people need to understand something before they buy it, so this is part of your due diligence about Peercoin. Otherwise, you're really just asking to be scammed. It's going to happen sooner or later. We've got a lot to cover though, so let's get started. First of all, we're going to talk about a history of cryptocurrency. This goes all the way back to 2009 when Bitcoin was first invented, or some say discovered. Anyway, we got to get a high-level overview, so that's going to help cover that. Then we're going to talk about proof of work versus proof of stake. Bitcoin is based on proof of work, and basically all other cryptocurrencies that use proof of work are copies of Bitcoin. There are a couple that aren't, but largely they are. And then Peercoin was the first cryptocurrency that used proof of stake as its security model, and there are now a lot of copies of Peercoin as well. So we'll talk about the basics of those two things. You don't want to miss that. Then we'll talk about 51% attacks. This is the most common attack to talk about. Everyone talks about, 51%, that's going to be the end of the world. There are other attacks possible against both Bitcoin and Peercoin. Those will have to wait for another video because 51% is like the basic, you got to be scared of this attack. So we'll talk about, the worst case scenario, all that good stuff. Then we will cover inflation rates and sustainability. I'm talking long-term sustainability. I'm not saying like, this coin's going to end in 6 months. I mean 10, 20, 30 years down the road, what is Bitcoin and what is Peercoin going to look like? We're covering Bitcoin kind of as a comparison to Peercoin, but you could insert your coin of choice here. Litecoin, the other coins all work the same way as Bitcoin, largely speaking. So I'm just using Bitcoin kind of because it's best known, but the others could be also, you could just imagine that I'm talking about them. They're all pretty similar. Then we'll talk about transaction fees. This is something that Peercoin handles completely differently from most other cryptos, so that's something we want to cover for sure. Then we'll talk about current developments in the Peercoin space. We want to know what's being worked on, because if nothing's being worked on, we probably don't want to invest in Peercoin. And then lastly, how you can get involved. So let's get started. History of cryptocurrency. Bitcoin was discovered/invented in 2009, January 3rd. It was launched, and this is long, long ago. A guy who went by the name of Satoshi Nakamoto launched a white paper and said this is how Bitcoin could work, and then he came out with a program and said this is how Bitcoin does work, and everyone ran the program and formed a Bitcoin network. It took, take a look at this, over a year before the first purchase was ever made with Bitcoin. This is the first documented purchase. Someone bought a pizza for 10,000 Bitcoins. Does that sound expensive? Well, it is expensive. Actually, 10,000 Bitcoins back in May 2010 was worth $30 or $40. So it was still a pretty expensive pizza, but not the $6 million that would cost today, at least at the time of this recording. You can see this link is actually blue. If you download the slide deck in the video description below the video, right down there, you can click this link and read about it. It's a pretty cool piece of history. Then a year later, Bitcoin price peaked at $35. This was considered a huge, huge bubble at the time. And after it hit $35, it crashed down to $2 or $3. It was a huge crash. So you invested at 35, then you sold at the bottom of the low. You basically lost almost all your money. A year after that, Peercoin was announced, and then a week later launched. This is important because Peercoin was announced before it was launched. And when it was launched, the source code was made open source, all at the same time. So everyone got a fair shot at mining Peercoin at the same time. This is important because a lot of coins today are not being launched fairly. The developers are keeping some coins for themselves, or they're hiding the launch, that kind of thing. So you need to know where a coin comes from to find out if it's really fairly distributed. So you also can click these links here. These are both blue. You can download the slide deck and go read about, these threads are on bitcointalk.org, which is the Bitcoin forum. Read about the launch of Peercoin. Make sure it was a fair launch. Then a year after that, this is basically 1 year apart, Peercoin peaked at $8. Now this was a huge, huge bubble for Peercoin. The price now is between $1 and $2 at the time of this recording. That might seem tiny to you if you're watching this in the future, or it might seem huge. I don't really know where the price is going to go. But I put both of these prices on here because I just want to highlight that when the Bitcoin peaked at $35 and then crashed down, people were saying Bitcoin is dead. It's now, only worth $3 each. Abandon Bitcoin, just forget about it. Well, a few people are saying the same thing about Peercoin now because it used to be $8 and now it's $1 or $2. But that does not mean Peercoin is dead. These cryptocurrencies are just very, very, very volatile. I mean very, 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 very volatile. So they could go up and down, in the blink of an eye. So this does not mean Peercoin is dead. It simply means it used to be very expensive. Now $8 might seem cheap. So if 8 seems cheap to you because it's now $30, you can make fun of me. My past self just didn't know what was going on. So this is your high-level overview. The point really here is to show that Peercoin is fairly launched and that it's following a normal kind of price trajectory, just like Bitcoin and a lot of other cryptos do. So now let's get into the nitty gritty. Bitcoin uses proof of work. There's a lot of good places where you can learn about proof of work on the internet, so I'm not going to go into a lot of detail, but I'm going to give you the basics so that if you don't know how Bitcoin works, maybe you can walk away with a little bit more understanding. So miners compete to mine Bitcoins by using their processing power. Basically speaking, this is very trivialized. Computers will pick a random number and then hash it, which is like looking very closely at it, and then say, was this one of the lucky winners that will win me Bitcoins? No. So then they pick another random number, hash that. Is that a winner? No. So they hash numbers as fast as they can. 1,000 hashes is called a kilohash, and 1,000,000 hashes would be a megahash. So they're measuring miners now in megahashes, no, in gigahashes, which is billions of hashes per second. Gigahashes of miners. And the whole network right now at the time of this recording is in hundreds of terahashes, which is like trillions of hashes per second. So this is a lot of mining going on. However, this mining is not like turn on your computer and run it in the background. This is because you're trying to hash as quickly as possible, run these numbers as fast as possible. You're running at 100% utilization. This is sucking a lot of electricity out of the system. So this is not, you just turn on your computer, leave it on overnight. This is hardware dedicated for hashing. When Bitcoin first came out, people could use their computers to mine because there weren't very many miners competing with them. It was a very small network. Over time, it became more difficult. More people joined the network. Then people started using GPUs, which is graphics cards, to mine because they're more efficient at doing this hashing algorithm. Then things got even worse. ASICs were developed, which stands for Application Specific Integrated Circuit, which basically means it's a piece of hardware that's completely useless, except it's really good at mining Bitcoin. So people bought these things up in droves. I mean, they were way overbought. The difficulty to mine just shot up through the roof, and all these ASICs are just running now, drinking electricity, because they require so much electricity to hash as quickly as possible. These ASICs mean most people now cannot afford mining equipment. You don't just go down to the drugstore, buy a Bitcoin miner, and run it in your house. We're talking major operations here. So only big companies are mining. Another interesting thing about the development of the Bitcoin mining. When it started, you could just mine on your own computer, and you could be your own miner. It was called solo mining, where you're searching for Bitcoins yourself. As the difficulty went up and it got harder, people had to form pools in order to kind of reduce the variance of the rewards, because you could mine for weeks and not find any, and then all of a sudden you find a whole one block, which is 25 Bitcoins. At the time of this recording, that's a lot of Bitcoins. That's like thousands and thousands of dollars. Nowadays, if you're mining all by yourself, solo mining, you could go years without finding any Bitcoins, and maybe never find any Bitcoins. So that's not really acceptable for miners. They need a return on their investment, so they form pools to reduce that variance. So when one person in the pool finds a block, everybody shares in the reward according to how much they mine. But what happens is you have to form pools. If you solo mine, the variance is just way too high, and these pools become larger and larger and larger. And this has become a serious problem in Bitcoin in the last few months. A pool called Ghash or gigahash.io is becoming enormous. It's like almost half the network now, and that's causing problems for Bitcoin security. Like I said, problems for Bitcoin security. So if you look at a pie chart of pools today, you're going to see one pool almost half the pie chart, and then another one like a quarter, and then, big slices of pie. So this is not millions of individual miners anymore. This is like just a couple of major players, and it's really hard to break into this because the pools, because of economies of scale, become more and more powerful the bigger they get. So it's just hard to form your own pool. No one will join it because they're already doing well in their own pool. So those are some of the downsides of proof of work. Sucking up electricity, hard to get into, great big teams that are hurting your security. So let's compare that now. Well, let's take a look actually at this beautiful diagram. So here's you on this mobile phone, and here's me on this laptop. So you're sending me a Bitcoin transaction. This green check mark is being provided by a big black box. This is not a user of Bitcoin. This guy right here is not necessarily acting in your best interest. This is a Bitcoin miner that produced the block that is storing that transaction. Now you might think, oh, that's okay. I mean, there's one here and there's one here. They look safe. Well, they are not safe. Here is a zoomed up view of a Bitcoin miner. Kaboom! This is like a giant warehouse. And this is what's happened to Bitcoin mining. This has happened over time. Like I said, when Bitcoin was first designed, the tenets were decentralization and people could run it on their computer. They actually put off switching to ASICs intentionally because that would kind of hurt the decentralization of Bitcoin. Well, now we're beyond the point of no return. Everybody who's mining is running great big rigs like this. It's no longer decentralized. So these are very wasteful. A big warehouse that's just mining Bitcoin is not really providing utility to society. Now, you could argue, well, it's securing the Bitcoin network, but if there's a good alternative, we should explore that. And that's what proof of stake, might be. So let's compare now proof of work to proof of stake. Minters compete by using their peer coins, not by using their computing power. So now anyone can use their computer to mint. In order to mint coins, I'm calling this minting because in Peercoin, you create coins with the coins you already have. You have a stake in the network. That's the peer coins you have. So you prove that stake by minting coins with it. So every second that goes by, it's a new second. So your computer is able to say, am I able to create new peer coins with the peer coins I have? Yes or no? If so, you mint a block and you get a small reward. The reward for Peercoin is 1% per year for minting. So that's very, very small, but it's still a lot better than earning nothing. So that's why people do mint. It consumes tiny amounts of electricity compared to Bitcoin because you're just running any computer you want and you're not running it at full throttle. You're not just hashing as fast as you can. Instead, you're just every second just checking a few things so it's easy to run as a background process while you're doing something important, like playing StarCraft. Mining pools also are not needed. Solo mining is just fine. As time goes on, pools will be needed for people who have very small amounts of Peercoin. Right now, it's not too important because Peercoin is pretty small, so people can still solo mint their Peercoin. But the pools do not become larger and larger as Bitcoin pools do because that variance is not actually reduced. If you gave your private keys to your Peercoins, which means basically giving the right to spend your Peercoins to a pool, then they could reduce the variance because they would say, well, these are my Peercoins now, so I can mix them all together and earn you 1% per year. But if you don't want to give that up, if you want to give them just the ability to mint for you, and this is coming in a future version of Peercoin, then that does not reduce the variance. Because they're only minting for you, they can only do what you would already be doing. So the pools do not get larger and larger, and minting actually gets more decentralized, which was the whole point. Now, this isn't immediately obvious that it's decentralized, but think about, for example, the US dollar. Can you imagine if one entity had to get half of all the dollars in the world in order to attack the dollar? It really wouldn't happen. If you take all the companies on the S&P 500 and pool all their cash together, that's nowhere near half. That's nowhere near anything near even 1% of all the dollars in the world because there's a lot of dollars out there. So this happens over time with Peercoin. It becomes more distributed because more people own Peercoins, and that makes it more secure over time. So here's a beautiful diagram of how Peercoin transactions might work. Here you are on this tablet right here. Here I am on this netbook. Wow, those are kind of obsolete now. And the transaction's going, it's being verified by what is that, an iPad mini? Or maybe it's the Samsung Mega, which is the world's largest smartphone right now. Shout out to Mega. I think it's an annoyingly, obviously large tablet. I mean phone. Anyway, the point is that this is not a giant server. Anyone could be verifying this transaction. So it's a lot more decentralized, and it's a lot safer in theory. In practice, we'll have to look at some of the attacks to see if it really is safer. So now let's talk about the security. We're going to go specifically into the 51% attack. We'll have to wait for other potential attacks for another video. So Bitcoin's mining leads to this 51% majority, and I would argue that this naturally happens to any cryptocurrency based on proof of work. The mining pools gradually get bigger and bigger. It's just economics. It's just scaling that makes this happen. And we're seeing this happen in Bitcoin. Gigahash.io is becoming the largest pool, and there's now security problems because of that. This happened in the Litecoin recently. A pool called Coinotron became almost half the network. And this will happen, I predict, in any pure proof of work currency. I mean, even Feathercoin, which is now very tiny, if it became huge, we would have these same problems. It's just a natural result of growing. So let's talk about what you can do once you've got 51%. The obvious attack is double spending. There's some good places to learn about this. You don't have to learn about double spending from me. But basically, you spend your Bitcoins, and then you have more than half the network, so you can just change the public ledger. You can say, okay, that I said I spent them, but now I'm using my power to say I didn't spend them. I'm spending them to myself, and you take them back again. That's called double spending. You can read about that. Just search the internet for Bitcoin double spend, and you can find out all about it. Another thing people don't talk about so much is total network domination. Imagine if you're 51% of the network and you just refuse to listen to the 49%. Anytime they mine a block, you just ignore it. Well, you've got more blocks than they do because you've got 51% and they have 49. So over time, you're the only person that matters. So 51% actually extends itself to 100% very quickly and very easily if it desires to. Anyone with a 51% network can just shut down anyone else, stop communicating with them, and all of a sudden they are Bitcoin. And that's very, very bad because it's completely centralized. And that allows transaction censorship. Another thing people don't think about very much. Right now, Bitcoin's decentralized, or that's the idea. So if I'm spending money to you, no one can get in the way and say you can't do that. No government can shut that down because all the miners are working together to do this. You'd have to shut down all the miners. Once you get 51%, once you get domination, any government can just take over the pool, send a couple police guys down there and say, hey guys, stop all transactions from this Bitcoin address. And they have to obey because it's the government. Everybody obeys the government. So what happens is they're allowed to control the wallets. No longer is Bitcoin decentralized, and this completely goes against the original intention of Bitcoin. So now let's look at Peercoin. What happens to a 51% attack in Peercoin? Same thing actually, but instead of 51% of the hashing power, you need 51% of the peer coins. Now maybe that sounds easy to you. It does not sound easy to me. It's hard to buy up half the peer coins. The reason is you go out in the market, you start buying, well, the price goes up. You keep buying, the price goes up. It is really hard to buy half because the price goes through the roof when you start buying. So you'd be better off trying to bribe the big holders to be on your side. And that's an interesting attack as well. Not something we're going to cover today, though. So because you have to use peer coins to attack, you're actually hurting your own investment when you attack the network. Some people say that makes Peercoin perfectly safe, like no one will ever attack it because they'll be hurting their own peer coins. That's clearly not true. Once the market is mature enough that you can easily short the market, then you could make a bet that the value will go down. Then you can attack the market with your peer coins, but because your bet is so extreme, you still end up making money. So that's a potential attack once you can short peer coins. Right now, it's not too possible because the markets are pretty small. It's not easy to get a big short going to attack the network. But over time, that'll be more of a concern. This is an important point. Having a great big farm of computing power is completely useless in attacking peer coins. All you need is actual peer coins. So it's completely different from Bitcoin. And because you don't get this centralization of mining, peer coin ends up being more secure because it's becoming more decentralized. Now that's a debatable point because each approach, proof of work and proof of stake, has its own interesting vulnerabilities. But I would argue that long-term, proof of stake can be more secure than proof of work. Woo, did you get all that? Let's take a quick break, drink some water. How you doing? That was a lot of information. We're about halfway done, so hang in there. All right, let's talk about sustainability. Bitcoin mining rewards. Right now, every time you mine a block, you get a reward of 25 Bitcoins, but that changes. In about 3 years, in 2017, that's going to drop off and be cut in half. And this is called the reward halving. It's well known. If you search the internet for Bitcoin reward halving, you can read all about it. That's halving, like cut in half. It's not like having like I have a reward. But because of that, because of this halving, I argue that this actually destabilizes the market because all these miners are brought online to mine Bitcoins because the reward is 25 Bitcoins per block. So there's all these miners mining, sucking up all this electricity, and then the reward cuts in half. Boom. What happens? Well, half the miners say this is no longer making money for me because I'm getting half the reward. I don't know if it's exactly half, but basically the mining power goes down. What happens to all those miners? Well, they're just turned off. People can't use them for anything else because they're ASICs. They're completely useless except for mining cryptocurrencies. So those are just out there floating around, and they could be used to attack the network. Someone could buy them all up for pretty cheap because they're useless, and then turn them all on at once and attack Bitcoin. So this could be a problem in the future. Now, we've only had one reward halving so far. In 2013, the reward went from 50 Bitcoins down to 25 Bitcoins. Actually, I don't know if the reward started at 50. It might have started at something else. But the point is, since the network has been pseudo-mature, as it is today, we've only had one halving, and that was when the price was shooting up. because Bitcoin price tends to do that. In the future, we're going to have a lot more halving. Every 4 years, the reward cuts in half, and we don't know what that's going to do to the market when the price is stable or when the price is going down. That's going to bring a lot of miners offline and potentially disrupt security. So Peercoin does use proof of work for mining, but it's for distribution. This is, like I said, for that fair distribution. When Peercoin was launched, there weren't any Peercoins, so mining had to be used to distribute them. And this was actually a fair thing. There are some coins that just say, well, we've created this coin and we own them all. Would you like to buy them from us? Some people say, well, that's fair because you invented it. I say it's a lot nicer to let other people mine the coin. So in that sense, Peercoin is more fair. And Peercoin mining is still going on, but the reward is dropping quickly. Every time the hash rate of the network goes up by 16 times, the reward cuts in half. And that was specially designed so that over time the value of mining would drop down so that mining did not play a big role in the growth of the money supply. This actually happened, I believe, a lot faster than the designer expected. He thought that the reward would gradually fall because 16x is quite a growth. But what happened is that these ASICs were designed and put out in the market very quickly. The technology advanced very quickly, and so the reward has dropped considerably. The first Peercoin block's reward was 2,500 Peercoins per block. So the growth was very fast. In the first couple of weeks, Peercoin mined a couple of million Peercoins. Today, the block reward is under 100 Peercoins. So that's a very, very big difference. Most of the Peercoins are already out there. That means you don't really need to worry about inflation so much. We'll look at some charts that give you more detail on that. But the money supply is not inflating as quickly as you would expect. Because the reward is halving and halving and halving as the hash rate goes up, it's approaching something that doesn't really affect the total money supply. So like I said, there's this minting where your money supply grows by 1% per year. That's going on to grow the money supply by 1%. The mining is gradually having less and less of an effect. And you can keep up with this inflation by minting yourself. If the entire network grows by 1%, but you also grow by 1%, then you haven't fallen behind. Unlike if you're holding dollars or euros and, the central bank is inflating the currency, you're actually losing value. Here, you can just mint to keep up with it so the inflation's not affecting you. So now let's take a look at some charts, and we'll talk about specifically long-term Bitcoin sustainability. So here is the Bitcoin inflation rate long-term, and I'm talking seriously long-term. Here's 2009. Here's 2013. Here's your first block reward here, cut in half. So this was the 50 reward. Here's the 25 reward. Time of this recording, we're in 2014. So we've barely started. This blue line here is the monetary base. So you can see lots of Bitcoins being mined, and then still a whole bunch, and then it gradually tapers off to 21 million. It's well known that 21 million is the most Bitcoins that will ever be mined. By the way, if you think someone's going to hack in and change that, don't worry, that's not something that's going to be hacked. A lot of things in Bitcoin could be hacked, but not this limit. Okay, maybe if it becomes completely centralized, but here's what happens. One miner says, hey, I'm making up a bunch of billion Bitcoins and I'm taking them all. The other miners say, that's not a legal block. You just made that up, and they just reject it. So actually this kind of enforces itself. All the miners say, I'm only going to listen to things that make sense to my program, and because everyone's agreeing to the same thing, this limit does occur. But what's interesting here with this red inflation rate, this is a log scale. So this is 1,000% inflation. Nobody wants that. 100%, 10%. This is something not a lot of people know. Right now in 2014, we have over 10% inflation in Bitcoin. And this is inflation of the monetary supply, not necessarily inflation of the price, which is just set by market demand, basically. But the money supply. This is something people don't know because they think, oh, there's only 121 million. I need to buy Bitcoins as fast as I can because there's only so many. They don't realize the supply is expanding very quickly. It's actually not until 2017 that this drops down to 4 or 5%, and then 2021 when it drops down around, that's still higher, that's still like 2 or 3%. So it's going to take a while for this to drop down. So there's a couple of problems with this chart in terms of long-term sustainability of Bitcoin. The first is this cutoff right here. All these drops, like I said, this shuts miners offline. Those miners could be used to attack the network later. So this is bad for the security of the network. The second thing is this gets down to almost zero. As you can see, this is 0.1%, and it has to, because if you get up to 21 million and you stop, you have to get inflation approaching zero. This is bad for the network because the network has to be sustained by miners, and as the block reward goes down and down and down, the miners don't have any incentive to mine anymore. The theory is transaction fees will grow enough to keep Bitcoin secure, but we haven't seen that happen yet. This is a gamble that there will be enough transactions to incentivize miners to keep the network secure. And if that doesn't happen, the security will drop more and more and more, and a 51% attack will become more and more and more possible. Let's compare this chart now to a Peercoin inflation chart. And this is something not a lot of people have seen. This is over the last year, so July of 2013 to 2014. We can't look forward because we don't know what that block reward is going to be since it's based on the hash rate. But it is declining. And you can see that because of this line declining as well. So you can see about 6 months ago we hit 5%. And we basically stay there, falling very, very slowly. This is about 4% from block rewards from mining, just distributing the coins out to new people. And it's about 1% from money supply growth. It's actually less than that because not everyone is minting with their peer coins. But the idea is the money supply grows by 1%. So this will trend overall down to 1%. Not that quickly. I would predict in a couple more years it'll be still 2.5%, something like that. So it's not going to hit 1%. But you know it's not going to really affect the value of your peer coins. Flooding the market with peer coins is not what's going to happen. Instead, it's just going to gradually grow by a couple of percent per year. So the real determiner of the price is, are peer coins useful? Do people want them? And are people using them for useful things? The important thing about this chart, though, is that there are no cutoffs. It's no giant drop because the reward just cut in half. It's much more sustainable. It's a gradual slope, except for this guy. He's a little bit weird. Another thing about this is that it doesn't trend towards zero. So we're not going to have a time when the entire network has to rely on transaction fees or just become completely insecure. Instead, it will always be secured by this 1% growth from minting. The mining isn't even needed to secure the network, and the mining is what trends downward. So let's talk about transaction fees because that's important in terms of the long-term survivability of the network. Bitcoin uses these transaction fees to motivate miners to mine. Now today, these transaction fees are almost nothing, especially compared to the block reward. 25 Bitcoins is a huge reward. It would take a lot of transactions to get that high. The theory is Bitcoin will become so valuable and the fees will grow so much that people will be willing to secure the network by mining. In reality, that's a big guess. And today, if you're actually to look at the rewards, inflating network, the rewards versus the transaction fees, you could actually say that each Bitcoin transaction is costing $20 to $30, maybe even $40 per transaction as a fee. But that's a hidden cost. It's not coming from the person paying. It's coming from everyone who owns Bitcoins because the supply is growing. So that 25 Bitcoin reward that's just been created out of nothing, that's actually could be considered a fee that's sustaining the network because the miners are receiving it. As that reward goes down to zero, we're going to have some interesting times ahead in terms of securing Bitcoin. And this isn't just for Bitcoin. All other alternative coins that use proof of work for security have the same problem. Peercoin, however, much different. It's able to destroy the fees completely to counter inflation. So I talked about the 1% growth. The fees are actually disappearing from the network and countering that inflation. So every time you pay a fee, that fee just disappears. It does not go to the miner. Bitcoin could not do this, or it would become completely insecure in the future. Today it could do this because that 25 Bitcoin block reward, it's no problem. It's keeping the network secure. But as that reward goes down, 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 down in order to keep inflation low, the network would just fall apart. So we're relying on the transaction fees here, and we don't know if that's going to work or not. It's a guess. Peercoin is not relying on that, so we know it's going to be sustainable. Peercoin minting and Peercoin proof of work rewards are predictable. We know what's going to happen. We know the network is going to be in the future, similar to how it is today. So I just wanted to comment here on blockchain bloat. Maybe you haven't heard the term. The blockchain is the public ledger of every transaction that's ever happened. And when you do a transaction, it's added to the blockchain. All the miners are maintaining this blockchain. Well, if a lot of transactions occur, the blockchain grows very, very large. And what some coins have suffered from is blockchain bloat, where there's just so many transactions that the blockchain becomes huge. Peercoin has a long-term view. It does not want a giant blockchain to inhibit people from adopting the network. So it uses a relatively high fee. It's one peer cent, which is 1/100th of a peer coin, per kilobyte in your transaction. Now, most transactions, if you're just sending money from one address to another, only takes 1 kilobyte. If it's a complicated transaction with a couple of different addresses here and there, it'll be 2 kilobytes, maybe 3. So this isn't huge. At the current value of Peercoin, of $1 or 2, this is just 1 or 2 cents in US dollar terms. So it's not a big fee. But cryptocurrency coins that use no fee at all, or very, very tiny fee, suffer from bloat. So let me show you a chart. This is really revealing. This is actually kind of old. It's from March, but you definitely get a feel of the relative sizes of the blockchain. So here's Bitcoin's blockchain, almost 20 gigs, growing very quickly. And Dogecoin, kind of embarrassed to be mentioning that here in this video. Litecoin, Namecoin, and Peercoin. Whoa, is this tiny or what? This is less than 300 megabytes, which is 0.3 gigs. These guys, on the other hand, are 2, 3, 4 gigs, and 20 gigs. Now, it makes sense that Bitcoin would be this ginormous because it's the oldest and it's the best accepted coin, so it's going to be big. Dogecoin, however, it does not deserve such a big blockchain. What's going on? Well, their fee is too small. This is a very young coin. It's less than a year old at the time of this recording. It's much, much younger than these other coins. It came out in 2012. Litecoin and Namecoin came out in 2011. No, Dogecoin is from 2013. So what? This guy's 2 years old. These are 3 years old. This one's only 1 year old, and this one's 4 years old at the time of this recording. So the reason this grew so big so quickly, they had their fee a little too low, and they mine blocks 10 times faster. A block comes out every minute, as opposed to these guys where it comes out every 10 minutes. So that causes that growth. This is really good for Peercoin. You might say, oh, nobody's using Peercoin. Obviously, it's useless. Not completely true. Actually, people are just being more deliberate with their transactions. They're not wasting their transactions on nothing, moving the coins to themselves from one wallet to another because of that tiny fee. 1 or 2 cents is a great way to deter people from just wasting money. The really nice thing about this tiny blockchain is that it can live completely on a very small device. So 300 megabytes, that'll fit on a mobile phone pretty well. Whereas if you're running a 3 gig file on your mobile phone, you probably don't want to keep that there. This keeps Peercoin even more secure because someone could run a full node, which is the entire blockchain, and run their minting on a very small, very cheap device. As opposed to these other coins, you'd have to dedicate more resources toward running a node. So this keeps Peercoin more decentralized, and it keeps it more secure in the long run. Okay, did you make it through all that? We covered proof of work versus proof of stake. We covered transaction fees. We covered long-term, and that's seriously long-term stuff. Whew. You have received Peercoin 101. Now you know enough to go to the forums and say, what's going on, guys? What's Peercoin? Now you don't appear like an idiot. Very good. Let's talk about what's being worked on Peercoin right now. We're working on version 0.5. Right now 0.4. Notice the 0? That's technically beta. So you might say, oh no, beta software, can't buy into that. Well, actually, Bitcoin is beta also. So, I mean, there's no real release stable branch of any cryptocurrency at this point. So it's not that bad. That's 0. Whatever. So what's coming in the next version? First of all, cold lock minting. This is where you can keep your coins safe in a cold wallet that's not connected to the internet, so no one can steal them, a virus can't get at them, and still mint. This is a really revolutionary feature. It's going to be a big deal for Peercoin security because it'll mean that people who are very paranoid about their coins can still mint with them, can still earn that 1% and contribute to the security of the network. Another thing that's being added to the next version is the ability to opt out of these centralized checkpoints, which I didn't really cover. When Peercoin started, there were no Peercoins. They had to be mined up from nothing, and when they were mined, only a few people were mining them. And so the designer added these checkpoints to make sure that no one with a large percentage of Peercoins is able to attack the network with their 51% of the stake. So these checkpoints are holding the network together right now, and over time they're being removed. So this version, you can now opt out of them. This version isn't out yet, but it'll be out soon. In future versions, it'll actually be default opt out, and if you really want checkpoints, you can opt in. So right now people say, well, Peercoin's not even decentralized because it has checkpoints. Well, yes and no. It does have checkpoints, but they were needed. As the network grows, I believe they won't be needed anymore. That's the topic of another video because some people think the checkpoints are holding the whole network together. If you really want to get serious, you should do some reading about that. So that's the next version. What else is being worked on? A really cool thing called Peerbox, which is running a Peercoin client, Peercoin node on very, very tiny hardware. In this case, a Raspberry Pi, which is like a $30 tiny computer with no screen, no keyboard, no mouse. The point is it's very, very secure because it's running only Peercoin software and nothing else. So it allows people to mint with a lot of peace of mind. This is being worked on right now. It's kind of in an alpha version. So you have to be pretty technically savvy in order to even run it, but over time, it'll become easier and easier for people to use. Another cool thing that's being worked on is called Peer Shares. You may have heard of this. It's a way for companies to have an IPO, which is an initial public offering, without paying the big bucks. So if you want to roll out your company, say, on the New York Stock Exchange, it's going to cost you millions. But with Peer shares, you can sell shares of your company just like you would sell Peer coins. So it allows companies to go public very, very easily. And it connects to Peer coins to allow dividend distribution. So that means if I'm a company and I've sold out my Peer shares, now I'm ready to pay dividends, which means pay all the shareholders a share of the profits. I could simply pay to the Peer coin addresses that are tied to those shares. So the owners can actually stay anonymous. I don't have to mail them a check. Talk about old-fashioned. I just click a button and the Peer coins go out. So this is a really exciting new technology. And the first implementation of it is called NuBits. I didn't throw it in the slide because it's not out yet. It's kind of under wraps, but you should keep your eye out for NuBits because that's spelled N-U-B-I-T-S, and that is going to be an interesting piece of technology when it comes out. Another thing that's going on in Peercoin is Peer Unity. This is simply wallet software, so you can download Peer Unity today, run it. It has a couple of cool features that the base software doesn't have, so it allows you to mint with your coins without having to become a hacker and type code into your console window. So a couple of new features are in there, and we're adding more useful things like a minting tab, so it's easy to keep track of how your coins are minting, that kind of thing. Lastly, but not least, Peer4Commit, which is kind of a weird name. It's a website where you can look at open source projects and check in code changes to them, update them, improve them, add features, and receive Peer coins in exchange. So if you're a programmer, you should definitely check out peer4commit.com, I believe, or just Google Peer4Commit and you'll find it. And take a look at those projects there because you might be able to get some free Peer coins that way. People who are looking at motivating Peer coin development can also donate Peer coins to the projects they're interested in. Or if you have a great idea for Peer coin, you could start your own project on there and say, hey guys, I've got this great app. You should donate Peer coins toward it. Instead of donating directly to you, because they don't know if you're just going to run off with the money, they donate to the website, and then as you work on it, you receive those Peer coins. So it's a good way to manage that entire ecosystem. So it's time to join the community. The obvious thing to do is go to peercoin.net, where you can download the wallet software, you can read about where you can buy Peer coins, all that good stuff. But the next place you definitely want to visit is the Peercoin Talk forums. This is very reminiscent of bitcointalk.org, which is where everybody talks about Bitcoin. Peercoin Talk is where we talk about Peercoin. I really like these forums because there are a lot of really intelligent people there who know more about Peercoin than I do for frequenting them. A lot of coins are like pump and dump scams where people create the coins just to get rich. And if you visit their forums, people are just talking about what's the price going to do next. These forums do not have a lot of discussion of, oh, I'm really trying to get rich. Instead, it's a bunch of nerdy engineers talking about pure coins. So if you're interested in the details, interested in marketing, interested in technical aspect, this is a great place to go. So come join us on peercointalk.org. It's a great place. Last but not least, you can follow at PeercoinPPC. At Peercoin must have been taken. PPC is the three-letter acronym. Whoops, what just happened? I lost my slides. Well, there we go. At PeercoinPPC if you want to follow on Twitter, and there's a Facebook page, facebook.com/Peercoin. So you've just received Peercoin 101. What do you do next? Definitely go to peercoin.net, check out Peercoin. Then go to peercointalk.org, create an account, say hi to everybody because we're an enthusiastic group of people and we would love to talk with you. This has been Intro to Peercoin. I hope you learned something. If you didn't, write in the comments and say you wasted so much of my time. But if you did, if you have any questions for me, you can still write in the comments below, or you can just go on the forums and catch me. I'm Kronos on the forums. Thanks for watching.